about it. Um, anyway, let's get into
Born.
it, John.
Yeah, we're recording, so let's get into it.
So yesterday, I don't remember if it was yesterday or the day before, but regardless, you were talking to a potential client, and during the conversation, it came up that you could have multiple policies, and this
Yep.
is something that maybe not everybody quite gets, from the whole idea. I mean, eventually, you hope that everybody gets it because that's really ultimately what this is about, is that it becomes the place where you store all your cash, and as your cash is growing, which is also part of the whole philosophy, is that you're making investments, taking money from the cash value and making investments, and you're making more money if if you've taken care of your credit cards first and all that. So, so you were having this conversation. You wanted to talk about that, how that all.
Well, yeah, interesting.
You brought up credit cards, because that was one of the things that uh, she's actually, she may end up listening to this someday. So I'm not giving
Yeah.
away her name or anything like that, but she buys and sells land. And I met her because we're part of a Facebook community and so forth, because I'm interested in learning about that. And I've been studying and so forth. So her and I became friends after we were on a call together, a group call together. And she said, sometimes I have smaller deals where, um, I need the cash fast. And, so we talked about me potentially lending her money. So she had reached out to me the night before, um, and said, would you be willing to, if I need it, would you invest in this piece with me, right? And pay a return. So I called her, and then throughout the conversation, we ended up coming down to, she was saying she wanted to move. She's going to have her third child, and she wanted to get closer to family again, probably for some good babysitters. And she said that she had some credit card debt, and she wanted to pay all of that off. And she had the cash, she had it available. And the interest rates now are crazy. I don't know of
Yeah.
people looking at these numbers, but like 27%. So
Yeah.
of course you're paying a lot of money just in interest. And so of course a person wants to get out from under that. And then I started talking to her about, well, this idea of paying yourself first, pay yourself first, put it into your own banking system first. I understand psychologically, emotionally, whatever, you want to get rid of this debt, and you don't want to be giving the credit card companies all this interest. But this idea that you're going to give up that money's use and growth, compounding growth for the rest of your life, is really hard to grasp for most people. Even I have to think about it a number of times and go, yeah, that's still the truth. And then I have to see the numbers. And when I see the numbers, hey, if I take this $25,000 and throw it at my credit card, get rid of the credit card, yes, I don't have that debt anymore. But I also don't have that money ever working for me again.
Right.
And the younger you are, I think, you have less experience of seeing, geez, if I had really done something different with my money all those years ago, I might have more today. I'd have less financial stress of sorts, all right? Or, hey, I just would have more money if that mattered, right? And of course, this isn't about money grubbing. This is about, trying to make life good and maybe a little bit easier financially, and allow you to have experiences that money can afford, right? And
Right.
so that was the beginning of why we started. She knew what I do for a living, and we had talked about it in the past, but we really got into it. Next thing we know, we're on the phone for like 2 hours. And at one point, Ray, she says to me, "Oh, so I can get a second policy on myself if if I've fully funded my insurance policy for this year because now I'm making more money. And where do I put the money now?" And first she said, "Oh, well, I can put a policy on my partner, I can put it on my kids." And I said, "Yeah, and because you're making more money, you can put another one on yourself." And she was like, "Oh, I didn't know you could put another." And I do think that happens to people. Yeah, that they don't realize.
Yeah. Yeah, because I think that most people have just, if they do have insurance, they have one policy. So they think they're good. You know what I mean? Like
Yeah,
and maybe they have a term policy,
right.
for the next 20 or 30 years, for $1 million, and
Yeah,
it's a low premium and they think they're good.
yeah, yeah,
But yeah, but and you can have multiple term policies, you can have multiple anything policies, right? You probably
yeah,
wouldn't have, speaking of insurance, you probably wouldn't have multiple coverages on your car, but on your life you can. Yeah. Yeah. So I
yeah,
think you're right. I think you're absolutely right that there's a lot of people that don't realize that is a piece of this, is that you can. And now this is also why I think it's really good for people to purchase the three DVDs from Nelson Nash Institute, where Nelson gets into it, for 6.5 hours. I mean, they trimmed it down. It was a 2 day workshop, right? Wasn't that what it was? It was a 2 day
yep, 9 or
workshop.
10 hours. Yeah.
And they trimmed it down to 6.5. They took out all the breaks, But he talks about all these different policies that he owned, and if people listen to him, I mean, right from the horse's mouth, where all this all came from,
Right.
uh, they would quickly realize that, well,
Yeah.
quickly, 6.5 hours later, quickly.
At some point during those 6.5 hours, hopefully.
Yeah, they that he talks about that. I had this policy, I had this policy on another person, a business partner. I had, that kind of stuff.
Yeah. Yeah. I
So
think in general,
what did she think about that? And did it expand her view of the
yeah, you
potential?
could tell there was like a light bulb moment, as they say.
Yeah,
It was just like, whoa, okay, I learned something. I didn't realize that that was the case. And oh, okay, that opens up things, in some way, opens up
yeah,
my mind.
yeah,
And I think just to go back to what you were just saying is I just feel life insurance it's not even just misunderstood. It's incredibly simplified in people's minds. Buy insurance, I die, somebody gets money. And that's really the end of it for most
yeah,
people.
yeah. Well, with that thought, what that scenario means to most people is that I don't really benefit from it.
For sure.
Somebody else does. My
Yeah.
child does, or my wife does, or my husband does. Not me. But no, I mean, again, if you purchase that 6.5 hour seminar from Nelson, you know, he talks about how we need financing more than we need death benefit because, chances of us dying early are slim. Can't say slim to none because it does happen. Um, and yeah, so that's great that she had that. Anytime anybody has a light bulb moment about any subject or any piece inside this subject, is awesome. So, ha,
Yeah, well, we were talking. Her and I were talking yesterday. I was going over some numbers with her, and towards the end, she says, "Well, it all makes perfect sense." you know, it's really kind of a no-brainer. That's what she said, right? But then there was that nagging thought. There was a nagging thought that I'm committed to this premium payment every year, that I have to pay whatever that contract amount says. And again, here's an uncomprehended uh, part of life insurance, permanent whole life, dividend paying whole life insurance, is the payment can be made by the policy itself at some point in time.
Yeah, down the road. Yep.
And so we have software, Ray and I have software that can show us how soon can the policy start paying for itself. So
Oh
I went
yeah.
in, yeah, go
You
ahead,
mean you
sorry.
mean via the dividend? Is that what you're talking about?
Yeah, or you're surrendering dividends. You could be surrendering some of the PUAs, and you could select a certain date. Hey, I want to start having the, some year 5, for example, I want to just let it start paying for itself. Or you can run the software to say, you figure out how soon that can be. What's the soonest date?
Yeah.
So I went in this morning because I wanted to, that was a conversation we had right at the end, and I hadn't created anything for her to look at. So I created an illustration and just did a video. But literally, in the start of the third year, the policy could stop paying for itself. It literally would pay all the life insurance. The only portion it wasn't paying for was the PUA, which is the optional amount
Right.
that you can pay into a policy. And what really drives the cash value up faster, is the fastest way of driving up your loan availability. Um, and so, but that's not required. It's not required to pay that amount. What is required is the life insurance costs of the contract, of the policy, of the
Yeah.
agreement. And so literally I showed, ran a quick little video, sent it over to her just to say, just so you know, this is another one of the flexibilities that you have. And people don't know that about life insurance because again, they think of it as buy a policy. If I die, then somebody gets paid.
Yeah.
Um,
Yeah. Yeah. So that's one way to do it, right?
yep, yep,
And that's another
yep,
point probably should make is that's just one way to do it. Now, I would advocate that, yeah, now she knows that that's an option, but don't exercise that option unless you have to. I mean, unless all of a sudden your cash income slowed down or stopped and you weren't able to do it
yep,
yourself because when you're doing that, you're actually slowing down the growth.
absolutely.
Uh, the other thing is that just say, for instance, um, she has a new baby and business slows down because she slows down and her attention is more on the new baby and the other uh, kids too. And so she's not making as much income coming in. She could actually just take a loan to pay the premium for a given year or 2 years, whatever she decided, if the cash value was available. If it had been enough
Abs-
years, like you're saying, 3 years down the
Absolutely.
road. So that's a possible. There's all these possibilities. So I think that one of the things I think about is, well, I'm going to get a little off track if I go down this road. Are you okay with that?
Sure.
Um, is that there are so many things inside whole life dividend paying life insurance with a mutual insurance company, and mutual because, again, because that makes you part owner, and that you have transferred all the risk, financial risk of insuring your life to the insurance company. The only thing that's going to change for them is that the dividends might change, the percentage that they're going to give each year just because of the market and the things they're investing that money in, right? How well it did in a given year. And um, so there's all these different things. You're passing all that risk on to them. They can change the dividend. What else can they change? Um, they really can't change much. But you, the owner of the contract, the policy, you have all kinds of things that you can do. And it can go along with your philosophy and strategy or a life change, like having a baby, um, starting a business, whatever it might be. You have a life change and you have had this policy for 3 years, like you use that example at 3 years. At 3 years, you also have cash value. And depending on how it was designed, and the design reflects your philosophy and understanding, your strategy and your understanding of how this whole tool works and how you can use, pull different levers and make different changes. Um, there's so many of those things that, to try to remember in our heads. So what I wanted to say was her your example of that the dividend would start to pay the base um, is an awesome thing, but she doesn't necessarily have to do that. Only if the situation comes up where, hey, I can't make this payment.
You stopped working. Maybe you broke a leg. You can't do anything.
Yeah,
Whatever it
yeah.
is.
Well, yeah, and there in lies. So maybe she can't work. Is that what you said?
Yeah, maybe. Yeah.
Maybe she can't work. So if you have a waiver of premium rider on your policy and you're disabled for a certain amount of time, at a certain time, they will waive the premium, not the PUA, because that's
Yep.
it's separate, but
The
the
life
base,
insurance premium portion.
yeah,
Yep.
they will waive it. And so the thing will actually keep going.
Yeah. Yeah. You
And
paid a
there's,
fee for them to be able to pick up the payments for you, basically.
yeah,
The life insurance payments still get made, but they pay it out of their pile because they've
out of
been
their check.
collecting a little additional
Yeah,
insurance money.
yeah,
Again, you insured against that, safe
yeah,
protected yourself. Yeah.
yes. Yeah. And it's
Yeah.
you can only get it up to a certain age. But if you're in your um, younger years,
20s.
yeah, well, 20s, 30s, and even 40s,
Oh yeah. Yeah.
put it on there
50s.
because you just never know, right? I
Oh,
mean,
sure. Yeah.
that's why we insure all these other things.
Everything. Exactly. Because we
Yeah,
don't
yeah,
know, right? The unknown. But yeah, and when in this 3-minute video I created to send over to her this morning, I just said, you know, it's showing in the numbers, right? It's showing every year, hey, this policy is paying for itself, right? But I
yeah,
said, that's not the way it has to be. Like you said, you could take out a loan. I didn't even say that to her. I said there was another option, but you literally could do it 1 year. And then
yeah,
you, of course, the reason you would prefer to put your own cash in is because not only is your cash going into the policy to start working and growing and so forth, but you've now not taken money out of the policy to pay for itself. That money stays in the policy, so to speak, right? So
yeah. Well,
you're not surrendering
it
anything.
stay yeah, it stays in there so that if it stays, the cash value is still there.
Yeah,
You need it
exactly.
if you need it. Whether
Oh
you
yeah.
take the loan or not, whether you take that loan or not, just say she does take a loan, and for 6 months she takes loans just to cover her expenses each month. And if she's with a particular type of insurance company, that money continues to grow unaffected by that. Um,
which is the
and
kind we
even
do.
with the other type of insurance, even with the direct or non-direct, even with the other one, it still continues to grow. You just get dinged a little bit on the money that's outstanding, but a lot of times those other insurance companies that might ding you are actually giving a slightly higher dividend at the end of the year too,
Right,
so
right. Yeah, it's easier to explain the non-direct, which means, hey, when you take a loan, they're not taking that off the cash value that then will receive a dividend.
right,
So if it's for example, 100,000 and you take 10,000, they look at it like you still have the 100,000 in there when they decide what percent of
right,
growth will we add to this through the dividend.
right.
And then the others, direct recognition is they base it on the 90,000 instead of the 100,000. But as you said, the dividend could be slightly higher. So it is six of one, half a dozen another for the most part. um, they're all competing against each other.
Yeah,
So then, and back to your point about the thing they can change, the insurance company could change the dividend rate. Yeah, but they're not changing it just arbitrarily saying,
right,
hey, we'd like to keep more of the profits, right? They want to pay these dividends. If
right.
they want to, and they want to pay them as wisely as possible, meaning not put themselves in jeopardy, but they want to give back to the policy holders who are their equity partners, really. And that's what
Mm,
they want to do is they want each and every policyholder is holding equity and they want to be equitable with them and they want to pay this. So the only reason they change it up or down is because that's what the business requires to stay wise and sustainable, right?
yeah, yeah. It's what
So
they it's how their investments have done and how much
yeah, yeah,
profit.
including the investments in lives,
Yeah,
meaning maybe
yeah,
there was more deaths that year for whatever
yeah,
reason, right? So, um, but in the end, it's profit sharing, and that's what they want to do, because that's good. Good. What's good for you is good for business, right? You, the policyholder. Whatever's good for you is good for their business because ultimately that's what they're doing is they want you to keep staying in partnership with them,
yeah,
um,
yeah,
and
yeah,
every single policyholder. They never want those people to go away because this is a good relationship. When they enter into a policy with an individual, they have said, I want to be in business with this person. That's really what I want to invest with this person. And they've made that decision for not just today but for the long term. If you're
yeah.
30 years old, they're saying they want to do this for the next 91 years.
Mm,
If that's the way it comes out to be, 121, I
yeah,
want
yeah,
to do it that long, and they made that decision on day one, and
yeah,
that's what we
yeah,
do. And so yeah, so for me, it bounces to trying to explain to people the difference between a structured loan and an unstructured loan. So a structured loan is when you have all these parameters, you have repayment terms, right? You have payment amounts that have to be paid at those particular points in time.
yeah,
And what an unstructured loan is, and the best place to do that is in the life insurance policy. And so to be able to retrain people to understand that there's no questions asked, there's no credit score that has to be met, there's no job required,
no
there's
tax
no
returns.
yeah, there's just no structure to it. And literally, you have the cash value and you say, I'd like some of that in the form of a loan. They just
Yeah.
give it to you. They don't
So
ask you anything.
so so why is it that they don't ask you anything?
Yeah, because they've already got your money. They're
Well,
not going to use your money.
no, well,
They're
what
not,
it is, in my opinion, the reason that they don't ask any of that is because they already have the collateral,
which is your money.
which
Yeah.
is your death benefit.
Yeah. Yeah. Well, yeah,
They're
they've already.
collateralizing the loan against your death benefit. Now, when you do a, would you call it a structured loan? When you do the structured loan, that bank is going to ask for all those things you just listed, tax returns and credit scores and all that kind of stuff. But they're also going to ask for some collateral because there's no death benefit with the structured loan. So they're
Yeah,
looking for
well,
collateral, right?
yeah, but okay, that's a great one, Ray. So let's expound on that a little bit and compare a structured loan uh, with a house and with a policy, and an unstructured loan with a policy. They both have collateral. One is the house is the collateral for the loan, right?
Yeah,
And but they've asked you for this to be structured. They've said, hey, we want you to pay back, X amount of dollars every month for the in the next 30 years, for example.
yeah,
And why is it the insurance company lets this be unstructured? They've got collateral too, right?
yeah, yeah. They
And
have collateral.
I have an answer to my own question if you want me to go first.
Go ahead.
Uh, well, it's proof that these policies are structured to grow. They are engineered to grow. There is no guarantee that the value of your collateral is going to grow in your house. There's no guarantee.
Yeah, right,
There's an absolute guarantee that the collateral of your policy is going to grow because your policy's value grows first at a guaranteed rate and then what they call non-guaranteed, which becomes the dividends. They say they can't guarantee, but they have been paying them for over 100 years consecutively. I'll say that one more time, and probably many more. And that is the difference is they want to make sure they get their money no matter what's happening to the value of that house collateral. They just saying, otherwise, you don't pay us, we're taking the house.
yeah,
And what happens with the collateral if you don't pay in a life insurance policy, if you don't pay it back? Well, someday you will die
right,
and they'll just take the loan balance right off the death benefit.
right.
They already have the money. They already have engineered. You cannot engineer the housing market. The housing market's going to do what the housing market does based
Yeah,
off of various economic and
right,
financial decisions that are made in the world.
yeah,
And it's not manipulated. The life insurance company is not manipulating things. They have systematically designed these policies to grow. As long as you do your part by making your premium payments, all the risk is on the insurance company.
yeah, yeah. That's a good point to make. That that the real only requirement for you is to make that premium payment. That's that's the
That's
only
it.
requirement that you have. And as you pointed out previously, you're on the hook for the base, but not the PUA, you know. Um,
Yeah.
and yeah. So the other thing, so this, I'm thinking of this chat as covering a lot of random topics, like this woman had the lights go off, oh, you can have multiples. There's all these little things that people might hear and then forget, and then hear and forget. I mean, even you and I are just studying this every day, and talking about it almost every day.
Yeah.
Um, there's still things you got to remember, so it's really good for us to continue to talk about it every day so that it stays fresh in our minds how this all works. And so I had a conversation with somebody, um, just via email back and forth, and a client, and he was talking about the design of the policy, meaning the split, 1090, 2080, 80/20, whatever it is. There's all multiple ways you can design it. And he was watching somebody that was talking about 1090s. And um, he said, I really believe in the way that this guy is doing it. And I was like, well, uh, I know you know that I'm not an advocate of that because it shortens it. First off, it doesn't build a good foundation for that particular policy for long-term thinking. And here's another thing that the human experiences. He said, I'm I'm at the point where I can't hardly plan ahead minute to minute. Like his life is so busy uh, that I can only like think. So he says, so I'm actually um, contradicting Nelson's strategy of thinking long term, 100 years or more. Uh, so there's that too. People are thinking that, geez, I need this, I need this to work like right away. And in a lot of ways, it can to a degree right out of the gate, right? When you start the policy, and I don't know what this woman was thinking, your client was thinking of putting in, but just say it was $10,000 and you designed it for, just say it was a 30/70, so it came up that um, 30% of that was base and 70% was PUA, and so it shows up as what would that what would that
The
be?
cash
Uh,
value you're talking about?
yeah,
Yeah, right. Well, let's just say 65 to 7,000, 6,500 to 7,000.
yeah,
It
yeah.
does.
So that would be a
Nobody's
billable.
holding us to it, but yeah,
Yeah, yeah. Nobody's holding. Just to get some idea. Just it's more about the concept, the thinking around it. So people get to the point where, hey, I put in this amount of money, and where did all that other money go away? Well, it went to guys like us, and it went
yeah, oh yeah,
and went to pay the salaries at the insurance company, all the tech stuff, everything it takes to run a business because they're running a business.
yeah,
And some of these folks that, and I'm not disparaging anybody. They can design it any way they want, but there's people that say this is the way to do it, 1090. And that's what he was talking to me about. And so I'll use that as the example. And I just said, if you understand how it works, it shortens the amount of time that you can actually fund it fully. It's very different than a 50/50 or 100% to the, but the cash value also changes too immediately out of the gate too. So if you understand that mechanism, how it floats, as you change those numbers and what it means, and you're okay with that, in other words, you're okay with that strategy, well, then, sign off on it and say, yeah, I'm okay with this. But he's having a philosophy, which I is totally great. Um, and I have a philosophy, which is also great. They can meet in the middle, or I can just say, well, if you understand this mechanism for you, this is for you, not me or us, then that's okay. We can do that. We can
yeah,
do it. Um,
yeah,
But why would you want to shorten the amount of time that you could put money into a policy? Why would you want to do that? And the other side of it was that when you get that filled up 10 years down the road and you decide, well, hey, now it's time to get another policy. And he was aware of this. We talked about it, that your health might be have changed in some way, which changes the rating that you'll get, which reflects on what the insurance will cost. Plus, you're 10 years older to begin with. Even if you're healthy, it's still going to be different. So if you can fund it fully right away out of the gate, why wouldn't you want to do that? But that's a philosophy, a strategy that I believe in. It doesn't mean that he has to. or other people have to. There's all these things to understand. I think some people say, well, I don't want to know what you know because it's way too much. But I want to try to have these people understand how it really works so they can make decisions now and in the future. Um, if they do decide to get more policies, and that starts to segue into the other thing I wanted to talk about was that this is really meant to be a system of policies, just like having a main bank and then having all the branches, um, that you're getting yourself out of credit card debt, getting yourself not necessarily out of the mortgage debt, but that's up to you. But getting out of debt that isn't good. And then as that cash value grows after things are taken care of, that you're taking cash value as your client is doing to buy and sell land. It's making other investments to grow your wealth, but your foundation is these policies. Okay, I'm out of
Yeah.
breath.
Okay. Well,
So,
I'll give you more details to that situation. So when her and I were talking about, I would lend her $13,000. She was already under contract to buy this piece of land from the seller, and I'd charge her over and above what, because I would borrow the money from my policy. And right now, let's just say it's 6%, charge somebody else 12%, right? So I'm making 6%, which is really what Nelson was talking about, right? Was always charge a higher rate, right? Than what the
that,
insurance company. So whether you're
that's what he
borrowing
was
for
doing.
your own, yeah, whether you're paying borrowing for your own purposes or you're lending the money out. It's the same idea. Of course, if you're lending the money out to somebody else, well, you're going to charge them something. Why wouldn't you charge yourself, say 12%, and pay it back at a 12% rate? And that way you always have more cash, which then when you have more cash, you eventually say, where am I going to put this extra cash? I can't put it in my policy. I've got no more room to put it in there. So I'm going to look for another policy for myself or on somebody else I have an interest in, a child or spouse or what have you.
Yeah,
And so what so when we talked about, hey, you have this credit card debt, she wants to pay off the credit card debt so she can get rid of all this crazy interest she's paying. But he said, remember, once you give it to the credit card company, the bank that holds that credit card, then that money will never work for you again.
right.
And think about, having a normal life, which is, let's say you make it to 85. I mean, that's going to be like almost 60 years of time that money will never work for you. But if you put it into a policy first, that's what Chris Noggle talks about. Just do one different step, take one
One
different
step.
step. And that step is to pay yourself first, put it into your banking system, into your policy. And I said, think about it this way. You put the 25 into a policy instead of paying it towards credit cards. And now, not only, yes, you still have a regular payment that you got to make on those, I think it was multiple credit cards, but let's just say it was one, right? I said, you still got to make your minimum payment, which is fine. But literally, you don't have to borrow from someone like me. You can borrow from your own policy and you can pay yourself back at 12%, borrowing at 6, paying back at 12. And let's say you already think you can sell this piece of land within 3 months, right? So you're technically going to recoup all the money, make a profit. And if it was 3 months, that's 25% of a year. So even at the 6%, you borrowed the money for 1.5% of that 13,000. So all you did was an interest only loan, because when you pay back the 13, the only expense you really had was the 1.5%, like for a quarter of a year. And so now you've got access to the cash again. So if you want, you could take that 13,000 back out and send it to the credit card company if you want. Now you only have, let's just say the balance now is only 12,000. Might be a little bit higher because there's interest being accrued, but for easiness sake, now you've only got 12,000. Yes, you have a loan with the insurance company. It's 6%, but not 27%. So you just took 13,000 of it off the table, right?
Hmm.
For that 27%, and it's 6%. And as you go along the next year, you go out and you borrow the second half of it if you want to, right? I mean, you have all the flexibility. That's the thing we're talking
Yeah.
about today, is
Options.
all these options. Yeah, all these options. It's there. It's not quite infinite, but that is the name of the concept, infinite banking concept. And
Yeah.
there's so many different things that can happen. And that's why when he titled his book, it was becoming your own banker. So you, yes, you hopefully get coached. Someone can give you mentorship, can give you some guidance, someone like Ray and I, and if not us. And you literally learn, hey, I have questions and I have, can I do this? Should I do that? What do you think? Bouncing ideas off of each other and saying what makes sense. And you learn to become your own banker, how you do things. And so, literally, not only could she end up making the profit on the land, but then she could also still get rid of some of the debt from the credit card and reduce it down to 6%. And then the next year, take out another loan if she wanted to and pay off the balance. But she's got the cash value. Now everything's at 6%. And when she pays it back, she has use of the money again. That concept that I am going to be able to reuse this money, in that if I don't do it this way, I'd never have use of that money again. I have to have
Yeah.
brand new money. I have to have brand new money to do it.
Yeah.
And to think that it just keeps stacking. She literally called it oh, so back to this multiple policies. She had said something to me about, have you ever heard of business credit stacking? So you end up getting these business credit cards and they start off at 0% for 18 months, and you just stack a bunch of different credit cards on top of each other, and then you're doing things with your business and moving in and out. And so later she says, oh, so you're talking about policy stacking. So you're actually stacking policies. And when you do that, it's your own personal and business credit. It's your
Mhm.
own bank, and you're in charge. Nobody's saying send us X amount, you know, and hey, we'll
Yeah.
only allow you to do this for so long. Uh, you get yourself in trouble with your policy, meaning you've taken out a lot of loans. Well, at least there's still collateral behind there, your death benefit, that if you can't make the payments or if you don't pay it all down, over a period of time, whatever that is, or you just
Yeah.
you don't have anybody that's going to say, hey, we're going to come and take something from you, you
Yeah.
know?
Yeah. Yeah. And so I just want to make a point about, saying you just said something to the effect that you paying it back over time. Um, you're Whether you did infinite banking or not, if you took this money out of savings, if she took the money out of a savings account and paid the credit card, she would she would still continue to save. In other words, she would put money, you could, like you're saying, paying back the loan with the insurance company. You're still think of it as not you're paying back. Think of it as you're saving. You're sending money
Mm,
back
yes.
into your banking system, just like you would if you were after you paid off the credit card, after you took it out of a traditional brick and mortar bank down the street. You wouldn't stop saving after you paid those credit cards off. No, you'd start to put money back in that savings account. Well, instead, like you mentioned, Chris Noggle, one step. You're just instead of putting it over there, you're putting it in here. And it's like savings. Like I made a video some time ago, incentivized savings. It's like to me, it was like I'm incentivized to put the money back in here. And I just wanted to make that point that
Well, yeah, that, yeah. Sorry, go ahead. Yeah, so,
they just think of it as that you're going to you're going to do this anyway. And I think that's another great thing that Chris Noggle talks about is you're just making this one step. It's just one difference, and it makes all the difference. You're just running it through this system first, and if you can be patient, like my client saying that I can only live minute to minute hardly. I mean, he's very busy. I know he's super busy. Um, he's like a Superman to me that he can do all that he does. Um, you're if you can think long term, and when I say long term, you can think that 5 years is long term or 2 years is long term or whatever, but if you can be patient enough to watch this grow, um, it's just that one step that's different that when you say that your money. Oh, so I know what I wanted to talk about was when you were saying that first year, she takes so much from the cash value and pays part of a credit card or the whole credit card. I can't remember what you said, but and by the second or third year, she's paid off all the credit cards. But what if, here's another scenario. What if, thinking of infinite, hey, out of the out of out of the video there, buddy. um, what if somebody came to her, a family member, and said, "Hey, I understand you're making loans to people to help them," and she might say, "Yeah, I am," and the person, family member says, "I've got, 20,000 in credit card debt. Would you loan me the money to get out of it? And how much would you charge me?" "Well, I'll charge you 12%." And that person says, "Great, I'm paying 30, you know. Um, and now it's year 5 for your client, so she's got a chunk of change. So she takes the loan and she's paying 6%. Let's just say that's just a number, could be 4%, 5%. But say she's paying 6 and she's charging her family member 12. So she's obviously making the 6. But she's taking 20,000 out of 100,000. So she's taking 20 and maybe she sets it up for 3-year payback. The interest rate on that 6% is going to be dwarfed in comparison to what that 100,000 is growing at. You follow what I'm saying? I know,
Yeah,
I
yeah.
know you do.
It's the uninterrupted compounding on your side, and you're paying interest on a decreasing dollar amount on the
Yeah,
loan side.
yeah,
So
yeah, yeah. And the other side that's different about the loans between a commercial bank, a regular brick and mortar, and the insurance company is when you send a payment, so say she's collecting $300 a month as a payment. She sends that 300 right through, she just sends it on back to her banking system. All 300 of that dollars goes to the principal, lowering the principal. Unlike your commercial bank where you send that money back and they're going to take a piece of that 300 to cover the interest for that month. So
exactly.
to me, that's a huge difference. It might not seem that huge to other people, but I think that's phenomenal that. And then once a year, they send you, the insurance company sends you a bill and says, this is what is remaining in interest for this year. Would you like to pay it? And you and I obviously advocate to pay that so that it stays a simple interest. But you're lowering the principal each time you send that 300 back to the insurance company. You're lowering it by that 300, which means that the 6% interest is accruing on a lesser principal. Right? So yeah, I don't
Yeah,
know.
I'll use the
Example of that 13,000 again, but let's say it's somebody who knows how to buy cars basically at a wholesale rate,
Yeah.
and they know how to sell it, and they can turn it over pretty quick. So let's say they buy a used car for 13,000 because they know how to buy them, and they sell it for 20,000 just so it's an easier number, right?
Hmm.
But they do that every month. They never pay their insurance loan back. Their money's still growing, doing its thing, right? But literally you're paying, and I'll use the 6% again. 6% of 13,000 is $780. So you're paying $780 to make. Now, in that example, I said they're making 7,000. They sell it, they buy it for 13, they sell it for 20. They do that 12 times, right? So 12 times is 84,000. So they made 84,000 for a $780 investment. They only paid 6% on that 13, but every time they sold that car for 20, they took the 7 off the table, like taking your chips off the table at the blackjack table in Vegas. You take your profits and you put the 13 back into play and buy your next car. Buy another car for 13, sell that for 20. But you only have taken out the 13 one time. You don't have to pay the insurance company back. At the end of the year, you send them a check. I'll just pay the interest for the year. I'll pay you 6%. I'll give you $780. So if
Yeah.
somebody knew how to do that, and I'm just using that as an example, people don't have to say, "Hey, I got to make 84,000." But think about the rate of return on that. You made $84,000 for a $780 investment. That's all because every time you never gave the 13,000 back to the insurance company. All you did was say, I'll pay him the interest at the end of the year, which is simple interest, and I'll give him $780. But I made $7,000 times 12. Again, I mean, that's where people don't understand if it or they do understand. I should say that more often. Those that understand this, they're doing things like that, right?
Yeah.
They don't, that's why you don't have to just put your money and store it away in a qualified plan. So bringing that up again, right, is because there might be other things you have an interest in that, you might like grandfather clocks, right? And, the world's a big world. You can maybe find somebody's got to get rid of the grandfather clock. Somebody died and, an estate sale and you're buying the grandfather clock for 7, but I mean, I don't know this market. I'm just using that as an example. But it could be anything. It could be anything that you like and enjoy and say, I know how to I know how to turn profit if that's what I want to do. I mean, obviously, if you want to collect these things, or you could do that too. But we're talking about utilizing the money in your policy because people get hung up on, hey, what is my cash value growth and what kind of return is that giving me? Like, how much, of a rate of return? Did I get 5%? Did I get 6? Did I get 12? It's
Yeah.
what you can do with the cash value. You don't have to do anything if you don't want to, right? It's still going to grow
Yeah.
and it's not going to have a lien on it if you don't take loans. But if you want to, right? And that's why even when you borrow for your own purposes, to buy something major like a car or to pay for a wedding or whatever, is that you respect your money just like you would respect your money if you were giving it to somebody else, right? You would charge them an interest rate. So you're borrowing at a wholesale rate and you're paying back at a retail. You'll always pay somebody for this for this cash,
Yeah.
and because the cash has value,
Yeah.
right?
Yeah. Yeah. Somebody's always profiting off of the banking function.
Yeah, yeah,
And it
exactly.
is a banking function. You know, banking isn't the building down the street. Banking is just a function, and
Hmm.
anybody can do it. And lots of different people have done it over the centuries.
Yeah.
Anyway, what else? There was, I'm just going to look at a note here that I made for myself because there was something I should think about. System your guide, explain. Suppose it kind of religious sign your lost. Oh, I know what I wanted to mention. Just it's a little off topic, but I wanted to just and I kind of touched on it a little bit, but just to change the subject just a little bit. Is it okay if I do that?
Oh, please do. I'm sure the audience would like it.
Um, is that we've talked about the flexibility, right? And so everybody's out on the internet looking at YouTube videos, or they're on TikTok or wherever they are. They're looking at stuff and they're trying to learn, what's right and what's not right and what's true and what isn't true. Number one, I'll just say there are no deals in life insurance. Okay. Everybody's working with the same parameters. Some might be taking a little more risk than others, but overall, they're trying to make a profit and stay in business and grow, right? So that's why the insurance companies that we work with have been around for 100 years or more. I mean, that's the bar. If you're below that, probably not doing business with you. But out on the internet, there's all including you and I, we're out there talking about this stuff. And so you've got all these different people talking about it in different ways. No, this is the way to design it. This is what you need to do. You should do it like this. You should do it like that. It's spoken about in so many different ways, and sometimes there's a little disparaging of the other person that they're doing it differently, saying, "Oh, you shouldn't do it like that." What it really ultimately comes down to is to understand how the concept came about, what it was designed for. You could, again, I'll plug that 6.5 hour video of Nelson Nash giving his 2-day seminar. It's a great resource to see what he was really trying to teach people. He's teaching them about life insurance, but he's also teaching them about how to grow wealth. So what I just really wanted to say was, if you come to understand how this works, everybody that's out there saying do it like this or do it like this or do it like this, they're all correct if you're good with that strategy. If you're good, if it fits your philosophy about how you want to manage your financial life. So come come to somebody that's been at this for a while that really understands what the concept was meant to be, and go from there. It has, like a lot of things, it has become more. It has become bigger in a sense, or maybe more sophisticated in the way that people talk about it. There's software out there that helps people talk about qualified plans and all this. But the bottom line is what is it that you want, the consumer? What do I want? Like my wife and I, what did we want when we designed our policies? How did we want them to grow? And I can just say from my standpoint, when I started my policy at age 67, last year, I wanted to protect her, my wife. And so I tried to get as much death benefit as I could quickly, because not that 67 is old, but you're getting there. And so I designed it in such a way that over time, well, first off, the death benefit is higher, as high as I felt like I needed at the time or wanted at the time. And then now I can also see into the future that, I'm pretty healthy, so I probably am going to live. But if I got hit by a truck, who knows? And as you know, you know my personal background, I've had a few accidents. Um,
Thank goodness it's been
Few and far between since your early days, but yeah,
yeah, since my earlier life.
yeah.
But I just really want to make the point that it's really up to you, the consumer, how this is going to be built, and that not any one way is right or wrong, depending on you, what your strategy and philosophy is around your financial life. And that's all I'm going to say about that.
Well,
I
and
just,
I'll add to that. I think what we're saying is speak with a practitioner that speaks to you, meaning speaks to you that you're comfortable, you feel like they're giving you all the facts. And as you see things out, maybe on the internet, about different ways of structuring and engineering these policies, what you want to do is say, if I did it this way, is there any drawbacks to that? Is there, whatever way you design it, yes, there's probably some things that you're agreeing to, that you're allowing to be a possibility, that this could be, something I don't want because of the way it can actually play out, and vice versa, whichever way it is. And I feel like I can talk about, when Ray's talking about 1090s, he's saying about putting only 10% towards the base life insurance, really to the whole life insurance and the term insurance that's included in these types of structures. He's just saying 90% goes to the paid up additions, or 90% goes straight to cash value. Is that something that you want? If that's what you want, okay, you should know about what it might not give you, right? And then you
yeah,
could structure it where 40% went towards the base whole life insurance and 60% went to the cash value of the PUA. And okay, what is the drawback of that? And people should know that somebody that they're talking to, a practitioner that they're speaking to, an agent, that they can talk about both sides of the equation and
yeah,
everything in between.
yeah,
And if they're not willing to do that and just show it to you without any bias, right? Then you have the facts. But what you're trying to do is get knowledge so you can make the decision that makes the most sense for you. And that's my addition to
yeah,
your commentary.
yeah, yeah. Um, with all due respect to Nelson and starting this practitioner program, my sense of philosophy and values is also that there are people out there, there are insurance people that have gone in and out of the practitioner program, meaning they were once practitioners, uh, they were life insurance people long before this whole thing even started. And they have come to understand it. But you want to be sure that they really truly do. If they're outside of the practitioner program, you have to figure out if they really understand. And so I would say contact John or I and just ask us what we think about this person. We may know them, and we could say, yes, they understand this, or, well, I'm not sure,
Yeah.
kind of thing. So I'm just trying to lay it all out there in that there are multiple ways to come to this, uh, right or wrong. really depends on your philosophy and your goals and desires. And we just want to be here to help um, bring whole life back to its golden age, I guess I'll call it. Because at one time it was part of everyone's savings program back in the 40s and 50s. I remember, I don't know if you remember, but I remember as a child, mom and dad had bought life insurance uh, through Gerber. Do you remember that?
Not really.
No.
I remember seeing these. I don't know what they were. I don't know if it was a letter or what was a payment or what it was, but that they had a life insurance on us on I think us kids, or at least maybe the first four of us. I don't know. I don't know if it's stopped or whatever, but I don't. I wonder. I often wonder whatever happened to those policies, but we'll never know that.
Well, yeah, they probably lapsed because
Or,
well,
or
either that
maybe they
or
cashed them out. Maybe they needed the cash,
yeah, maybe they're still in force. Who knows, right?
I
They
actually
literally could.
yeah, I
Yeah, they
actually
could be.
I
Well,
went
it's funny
looking
because
for it one day, but I couldn't.
yeah, well, we both have policies with Lafayette Life, and Lafayette Life is owned by a company called Western and Southern. So there's a big conglomerate that owns multiple insurance companies, and they own Gerber, which is kind of funny.
Oh,
Yeah,
huh,
yeah, they actually own, and
I didn't.
that's one of the biggest uh, divisions. It's probably might even be the strongest division they have is Gerber Life.
Huh.
Yeah,
Maybe that's where I started. Maybe that's how I started thinking about it because I saw it on Lafayette. So yeah, we have Lafayette and Penn Mutual here in our family. And I will say too that you and I are licensed with many others as well. So if
yeah.
somebody's kind of attached to one particular carrier or not, don't think that we can't help you. We can certainly help and guide you and want to uh, in any way, shape, or form if we can help. So, anything else you want to?
Yeah, there'll
Be
be
more to say, but I think this is a good wrap up. Yeah, we probably should keep it brief. I don't think it was too brief, but
Yeah, yeah.
yeah,
Maybe
yeah,
brief
I
for
think
us.
well, yeah, because we could go on and on, but
uh,
yeah, I think it
anyway,
just remembering that there's a lot of options, and what you think you might know about life insurance, we're trying to educate you to say there's so much more, obviously, and it's a valuable part of your foundational life, right? So
yeah, yeah,
let's let's keep it
yeah.
going.
All righty. Well, good to see you this morning, John. And
Yeah, great to see you, Ray. It was great talking, and glad we got this in.
all right. Have a great day.
Yeah,
And
you too.
please subscribe, hit the bell, and please share and like these videos. And any comments, we'd love to hear from you. It's always great to interact. It's kind of a one-way conversation this way. So please do reach out. Uh, it's always wonderful to talk to folks. So anyway, thanks again, John, and we'll catch you next time.
sounds great, Ray. Look forward to it. Bye.